Okay, so if you're a service member getting ready to deploy to a combat zone, you've got this massive opportunity to build some serious wealth. But, and this is a big but, there's a hidden danger lurking inside the Thrift Savings Plan rules. It's what we call the combat pay trap, and it can literally cost you tens, even hundreds of thousands of dollars in retirement. In this explainer, we're going to show you exactly how this trap works, and more importantly, how to sidestep it completely. All right, here's our game plan. First, we'll dive into the core paradox of combat pay, what makes it so unique. Then, we're going to dissect the trap itself, piece by piece. After that, we'll build the ultimate 2026 playbook, cover some pretty advanced strategies for specific situations, and finally, we'll show you the escape hatch, just in case you need to fix some past mistakes. So let's start at the very beginning. We've got to establish the one fundamental concept that this entire strategy is built on. It all boils down to a super critical distinction that most people get wrong. But if you get this right, well, you're going to unlock some absolutely massive tax-free growth. First things first, let's define the amazing benefit we're working with here. It's called the Combat Zone Tax Exclusion, or CZTE, and it comes from the Internal Revenue Code, specifically Section 112. Now, what it does is it makes your active duty pay that you earn in a combat zone completely exempt from federal income tax. Now get this, for enlisted folks, this exclusion is totally unlimited. For officers, it's capped, but it's still a really high cap. We're talking over 10 grand a month usually. This rule right here, this is the bedrock of everything we're about to talk about. Okay, so here is the crucial point. This is the distinction you have to understand. The money that hits your bank account from that deployment paycheck, that is tax-exempt income. But, and this is key, that does not automatically make it a tax-free asset for the rest of your life. See, a tax-free asset is the account you put it in, like a Roth TSP. That's where the growth and your future withdrawals are also tax-free. Where your money comes from doesn't give it that power. It's all about where you put it. So now let's see how that one little distinction can create a massive financial trap over the years. This is where a small choice you make while you're deployed can have a gigantic financial impact, decades down the road. The seed and the harvest analogy is just the perfect way to understand this whole thing. Normally, with a traditional TSP, you get a tax break on the seed, that's your contribution, but you have to pay taxes on the entire harvest later on. With a Roth, it's the opposite. You pay tax on the seed, but the harvest is all yours, tax-free. Well, in a combat zone, this whole logic gets flipped completely on its head. And this right here lays the trap completely bare. When you're using combat pay, that seed money is already tax-exempt, no matter which account you put it in. So the real difference, the critical difference, is the harvest. If you put it in the traditional TSP, all of that growth, all those earnings over the years are going to be taxable. But if you put it in the Roth TSP, the growth is also tax-free. You get a tax-free contribution and tax-free growth, which creates this incredibly powerful triple tax-free asset. It's a no-brainer. Let's put some real numbers to this. Let's meet Sergeant Smith. She's 25 years old, and she contributes $20,000 from her tax-exempt pay during a deployment. And just for this example, we'll assume an 8% annual return over 35 years and a 25% tax rate when she's in retirement. And here's the long-term impact. Look at this. After 35 years, that 20 grand grows to almost $300,000 in both accounts. But with the traditional TSP, all those earnings are taxable. So after you chop off 25% for taxes, the net value drops to about $226,000. In the Roth account, that entire balance is hers to keep. Every single penny completely tax-free. The difference is just staggering. The cost of falling into this trap, just from this one single contribution, is almost $70,000 in lost future buying power. It's the same money in, same market performance, but a wildly different outcome, and it's purely because of how it's taxed. But here's the thing. This isn't always about just making a simple choice. For those of you who are high savers, the system itself can actually push you into this trap. Because of IRS contribution limits, once you've filled up your designated Roth space for the year, any extra TSP contributions you make are automatically forced, or what we call spilled over, into the traditional side. We're going to break down exactly how that works next. Okay, so let's shift gears and talk about the solution. Let's build an actual, actionable playbook for 2026. This is all about being strategic, knowing the rules of the game, and making every single one of your dollars work as hard as it possibly can for you. So to build our strategy, we gotta know the rules. These here are the key IRS limits for 2026. The elective deferral limit that's under IRC Section 402G is $24,500. I want you to just think of this as your Roth cap inside the TSP.
Then you've got the annual addition limit under IRC 415C. This is the big one, $72,000. That's your total cap from all sources. And then you've got separate limits for catch-up contributions if you're over 50 and for a totally separate Roth IRA.
This is what we call the Super Max Protocol, and it's a strict hierarchy. You have to do it in this order. First, you max out your Roth TSP up to that 24/5 limit. That is your absolute highest priority. Second, you go outside the TSP and contribute $7,500 to an external Roth IRA, which has its own separate limit. Third, you put $10,000 into the savings deposit program to lock in that guaranteed 10% return. And only after you have filled all three of those superior buckets do you continue making contributions to the TSP. And that extra money will automatically spill over into the traditional side, filling up the rest of that big $72,000 annual limit. Okay, now for some of you in various specific situations, there are even more powerful strategies you can use. The tax code, well, it has some really interesting quirks that create these unique little opportunities for certain service members. So for members who are aged 50 and over, there's this great little strategy called the Roth sandwich. It exists because of a funny quirk in the rules that says catch-up contributions in a combat zone have to be Roth. So what this means is you can contribute your first 24/5 to Roth, then have your spillover money go to traditional, and then, on top of all that, you can add another $8,000 in Roth catch-up contributions. It's like an extra layer of that tax-free goodness. And for you reservists out there with civilian jobs, oh man, you can exploit a major loophole. See, the 24/5 elective deferral limit is per person, but that big $72,000 annual addition limit, that's per employer. And since the military and your civilian company are considered unrelated employers, a reservist effectively has two separate $72,000 limits. It's wild. This lets you max out your civilian plan and contribute huge amounts of your tax-exempt pay into the TSP, potentially sheltering over $140,000 in a single year. But what if you're watching this and thinking, oh no, I've already been making these tax-exempt traditional contributions for years? What if you're already in the trap? Don't worry, there is an escape hatch. There's a way to fix it after you separate from service. The issue you run into in retirement is something called the pro rata rule. Basically, your tax-exempt contributions get all mixed together with all your other pre-tax contributions and all the taxable earnings. It's like one big soup. So if you try to withdraw just your $50,000 of tax-exempt money, the TSP says nope and forces you to take a proportional slice of the taxable money along with it, which, you guessed it, triggers a tax bill you didn't want. But the solution, and you do this when you separate from service, is called the split rollover. It's like a surgical maneuver. You tell the TSP to roll over your traditional balance, but you send it to two separate destinations. All the taxable money goes to a traditional IRA. That's a tax-neutral move. And then all of your non-taxable, tax-exempt combat contributions, they go directly into a Roth IRA. And because that money was non-taxable to begin with, this move costs you zero in taxes, and it effectively turns that money into a Roth asset for life. It's brilliant. So let's just recap the absolute must-know points here. When you're in a combat zone, Roth is king. Always prioritize your Roth TSP and your Roth IRA. Second, follow that Supermax hierarchy to the letter to make sure every dollar is in its most tax-efficient home. Third, you got to understand that the spillover into traditional TSP is really a tool for saving a high volume of money, but its growth will be taxed. And finally, remember that the split rollover is your powerful exit strategy to clean this all up when you leave the service. You know, mastering these rules isn't just some boring academic exercise. It's about making sure that the sacrifices you make downrange in a combat zone translate directly into the maximum possible financial freedom for the rest of your life. Your deployment is going to end, but a smart financial strategy, that's going to pay you dividends for decades to come.